Look at the balance sheets of the world's most profitable entities. Often, the individuals and corporations generating the most massive pools of capital incur a significantly lower proportional tax rate than the average wage earner. To understand how this happens, we have to look past the political rhetoric and deconstruct the exact mechanical pathways these entities use to minimize their liabilities. This chart visualizes our first pathway: tax evasion. This illegal methodology relies entirely on creating fraudulent information asymmetry. Contrast that with tax avoidance. This legal mechanism relies on structural planning and jurisdictional arbitrage to steadily reduce obligations towards zero. The distinction comes down to mechanics. One approach involves hiding assets and lying to break the law, while the other weaponizes the exact definitions of the law against the state itself. Gross revenue flows downward into a taxable income node. Evasion severs this flow. Through underreporting, revenue detaches and bypasses the node entirely. Another tactic is false deductions. By artificially expanding operating expenses on paper, a business effectively crushes its remaining taxable margin. Domestic tax authorities monitor inputs and outputs closely. If an audit detects these asymmetric reporting tactics, the result is immediate criminal liability. This makes evasion a highly fragile strategy. It depends entirely on maintaining a severed data link. The moment the government discovers the true numbers, the entire structure collapses. To scale this massive level of obfuscation, wealthy individuals historically looked far beyond their domestic borders to securely hide their capital internationally. For decades, the prime destination was Switzerland. Swiss banks offered stringent national privacy laws that legally prevented sharing account information with foreign authorities. By routing capital to a non-reporting jurisdiction, individuals sever the data link, leaving the home government blind. But international pressure dismantled this sanctuary. Treaties now require institutions to share data, restoring the reporting link to the IRS. Simply hiding money offshore is now a mathematically finite strategy. As global financial transparency increases, the information asymmetry resolves, turning former tax havens into traps for tax evaders. With hiding money no longer viable, multinational corporations execute a different strategy. They strictly adhere to statutory law, utilizing legal tax avoidance to optimize liabilities. One of their primary tools for doing this is the controlled foreign corporation, a foreign entity set up specifically to hold profits in low-tax jurisdictions. The peak execution of this architecture occurred between 2009 and 2012, when Apple legally shielded $44 billion from domestic taxation. Apple established an Irish shell company. U.S. tax law claims residency by incorporation, Irish law by management control. By incorporating in Ireland but managing from the U.S., Apple found a contradictory overlap, creating a stateless 0% liability zone unrecognized by either nation. Elite tax avoidance relies on the legal reclassification of capital. By exploiting the contradictory definitions between sovereign nations, these entities keep their assets visible to regulators, but beyond their statutory reach. Another method for manipulating these geographic rules is transfer pricing. This occurs when different branches of the exact same parent company buy and sell goods, services, or intellectual property from each other. The goal is to move profits out of high-tax domestic markets and into subsidiaries established in 0% corporate tax havens like the Cayman Islands. A U.S. corporation generates $1 million, normally facing a 35% tax. By transferring patents to a Cayman subsidiary, the U.S. branch pays an $800,000 licensing fee. This shifts capital into the tax-free haven, shielding it until reform lowers rates for discounted repatriation. Through multinational structuring, taxation ceases to be a fixed operational cost. It becomes a highly manipulable variable dictated entirely by geography. This type of optimization isn't restricted to corporate entities. High net worth individuals construct personal portfolios to achieve similarly compressed effective tax rates. This creates a well-known dynamic where highly successful investors openly state that they pay a lower effective tax rate than their administrative staff. They accomplish this by structuring their compensation away from traditional salaries, deriving their wealth instead from qualified dividends and long-term capital gains. Looking at this chart comparing statutory limits, the difference is clear. Ordinary wage income faces a marginal rate that can easily climb past 22%. However, long-term capital gains are capped at a heavily discounted 15%. The tax code doesn't treat all income equally. It deliberately and mathematically incentivizes capital investment and asset ownership over daily wage labor. As we analyze these structures, we have to recognize one final distinction: the mechanical difference between true tax avoidance and tax deferral. Common strategies like 401k accounts or 1031 real estate exchanges delay tax payments to a future date, maintaining the ultimate liability. True tax avoidance permanently zeroes out the financial burden by locking capital into the statutory arbitrage frameworks we've examined. The tax code functions as a macroeconomic behavioral incentive structure, dictating how money should move. Tax optimization is simply the act of legally aligning capital with those specific rules.